What's up, guys? What's going on? Good afternoon. We'll get started in just a minute. Make sure everything is working well, running smoothly. Sound check, please. And then we'll get going. How's everybody doing this afternoon? It's a fine Tuesday. Got a big day tomorrow, but I don't think I'll save my opinions on it, actually. Just give me a quick sound check. Turn down the background music. Maybe a little bit of a lag. Sound is okay. Cool. What's up? How's everybody doing? Happy Tuesday. It was snowing earlier, so I don't know if everyone was on the East Coast, but it was snowing lightly this morning, which is interesting because it hasn't snowed at all this year. And for those of you that are not aware, I am based out of New York. I live on Long Island, and usually by this time, I want to say usually, but maybe it's changed in the last few years. Global warming. Usually by this time we have some snowfall. We're always good like once a year for, getting walloped at least once or twice. And it feels like it gets pushed a little bit later each year, which means that you think everything is cool and you're in the clear. And then like the end of February, early March, maybe we get some kind of blizzard, some kind of ridiculous snowfall that then lasts and stays on the streets for, another month. Midwest here, so always snow. Nice. It's pretty for a short amount of time, and then it gets disgusting, and then it gets all over your car, and then it mixes with the sand and leaves that kind of nasty chalkiness on everything. Anyway, thanks for tuning in, guys. It's the first stream this week. I streamed last week. It was a really good stream last week. And I want to stream more, but conditions have been really good. And when conditions are really good, I'm honest about this. I prefer to trade, and I prefer not to stream. It's just, it takes up time. And right now there's a little bit of a lull, and I think it's because FOMC is tomorrow. We had some good movements this morning, but I think we have a decent break. And then we'll probably pick up right after tomorrow and continue what I think will be continue to run. So anyhow, if you're not subscribed, hit the subscribe button. If you're not subscribed, hit the subscribe button. But I also appreciate if you hit the like button. I am trying to grow this YouTube, so I do appreciate your engagement and your presence. Remember, none of this is financial advice, strictly for entertainment purposes only. For those of you that are interested in trading all of the alts that you see me talking about, they are all available on Phemex. All right. For the longest time, KuCoin was like the leading exchange for trading alts. KuCoin, whatever the fuck it is still a good competitor to Phemex. Both of them don't require KYC. Both of them offer futures and spot. I just trust the people over at Phemex more. I mean, obviously, been working alongside them now for quite some time. But if you're interested in trading there, they're still offering right now a $6,000 sign-up bonus. But you know the deal. You don't just get $6,000 for signing up. It depends on how much you deposit, but it all adds up. If you're trading actively and you're incurring fees or you're beginning to accumulate fees, it's nice to have a little bit of those knocked off the top. And that's the benefit of having some kind of sign-on bonus. There also is a big change coming to the exchange in the next month or so. I think it's the next month or so. So that should be exciting. I can't say anything about it, but it is something that I think is really novel and not being practiced by any other exchange yet so far. But you know how that works in crypto. When one exchange does something, then everybody else copies to some degree. Okay, let me look at the chat. Some familiar faces. How quick is your M5? My M5 now tuned runs 0 to 60, and I think around 2.6, 2.7. I haven't really pushed on it too much. This is my second, and this is a 50th anniversary edition. I had it tuned, so it's running around 700 horsepower, and it is an absolute beast. And yesterday was the first day that I drove it into New York City, and I was excited because I got to drive it through the tunnel, and I haven't driven a tuned M5 through the tunnel, and it was incredible. So, what part of the island, bro? I was born in Huntington. So I was born in Huntington, and now I live not too far from Huntington. Okay, cool. Let's get started. All right, so first things first, obviously, FOMC is tomorrow. So if you guys are not aware of, some of the major macro events, some of the things that have become relevant as of the last year, Forex Factory is a great resource for the main calendar catalyst drivers of the market, right? So macro events, releases, FOMC, CPI, non-farm payroll, all the things you see me talk about. If you want to know when they are, go to Forex Factory. This is a free shield for Forex Factory. They've actually made it easier. So I'm actually looking at the entire economic calendar. So as you can see, today we had a few relevant pieces of data release, employment cost index. We have everything else behind us now. Chicago PMI was at 945. But tomorrow, as you can see, it has the FOMC. The statement's at 2, the presser's at 2:30. And this is the aggregated economic calendar for everybody, right? So not for everybody, but if you trade Forex, if you trade, legacy, you trade commodities, you trade equities, you trade crypto, it's all in here. All of the details, right? It labels them based on how significant they are. So you can see the ones that are red are obviously very significant. If you don't want to sort through all this, they did the kind work of putting together the crypto calendar, which is basically a trimmed down version of that main economic calendar. And it has all the things that have been relevant as of the last year to crypto that are also in legacy, right? So we know that crypto and legacy are very correlated, right? Crypto is just it's risk. That's all it is. It trades like high beta to equities. So it trades similar to tech stock. Now there's some obviously properties that make it unique outside of trading, let's say just stocks, for example. But it does trade around equity risk, right? So most of the year, it was very correlated to the S&P 500, the NASDAQ, the Russell. And again, it was trading like a tech stock. So higher beta, so more upside, more downside, right? The good times are when there's less downside capture, right? So when equities are moving down and crypto is not moving down as much, and when it is moving up more. So it's most of the time going to be moving up more than legacy. So if you see the S&P up 10%, by that alone, you could usually jump to the conclusion that it's a 2 to 3x that. So I just pulled 10% out of my ass, but if the S&P is up 2%, Bitcoin more often than not is going to be up at least 4%. Okay, get it? So they're very correlated. It's been this way for a really long time. There's brief periods of decorrelation, but that decoupling bullshit is a meme. You should just operate under the assumption that crypto risk is going to trade very correlated to or be highly correlated to legacy risk. So if Apple is down, Bitcoin is down. Okay, got it? Obviously, crypto will vastly outperform off the bottom, right? But obviously, you have to be able to identify where the bottom is. Okay, and if you're identifying the bottom in the S&P, good for you. It's probably better to be in something like BTC. I'm drinking Athletic Greens right now, by the way. All right, so I mentioned this because, yeah, crypto is doing really well right now, but so is the S&P. If the S&P was to take a nosedive and put in some kind of, move that is multiple standard deviations of norm, not just intraday noise, then everything that's taken place up to this point in crypto, all of the bullish narrative that's begun to get respun up, that all goes to nothing, and crypto follows twice as fast. Okay. All you're seeing right now is people get really excited about momentum coming back to the market, and they have a right to, because the market has gotten its ass kicked for a long time. Traders that did really well in the bull market had a really tough time in the bear market. So everyone's excited right now, and they're starting to respin up the fundamental narrative bullshit. But at the end of the day, all markets right now are moving up, and crypto is just moving up more. So if legacy shits the bed, crypto shits the bed as well. I personally don't think legacy is going to shit the bed. I think it's just a really important point to. I think it's really important to point that out. Okay, that relationship still exists. All right, so FOMC tomorrow, really quickly. My game plan with FOMC and with CPI and with non-farm payroll and with these significant calendar events for legacy is that the first move is always bullshit. Now, this is with respect to intraday trading. So typically the market will disseminate that information over the honest move will come 48 to 72 hours after. So after that period, all of the noise is worked out. And if the data is bullish, if the market is going to determine it to be bullish, 48 hours out, you're probably not worrying about getting head faked by that data, right? 30 minutes out, different story. 5 minutes out, different story. The move that usually happens between the 1 second after release, right, the 1 millisecond, nanosecond, whatever, how fast you could get that data, up to 30 minutes is usually a false move. So a lot of times what you get is the market spikes up, the market spikes down, might spend a little bit of time consolidating higher, a little bit of time consolidating lower, and then you get a reversal. And it has nothing to do with the data. It's all about positioning at that point. I don't try to predict that move. I react to that move. All right. I'm not sitting here saying, like, I think the market's going to rip up tomorrow right after, or I think the market's going to snap down right after. It makes no sense for me to try to figure that out. I don't have an edge trying to figure that out. I do have a set of eyes, though, and I can see that happening on the tape. So what I'll look to do is, hey, crypto has, for the entire year, given a little bit, the benefit of a little bit of a lag. So you could trade BTC directly, by proxy for the S&P. You could take it out a notch and trade alts around it. But if the S&P, if you could get the jump on it, right, and let's say the first move is that it spikes up and you're in you're in an alt, you're in ETH, and you see that it hasn't responded yet, a lot of times that's your signal. Okay, and you could get behind that first trade. And for me, that's usually been something that I've been in and out of mechanically, right? So I see it, I respond, I get out at a predetermined take profit. And a lot of times that's between, 150 to 200 basis points. So, 1.5% to 2%. Never letting it ride there because I don't think it's the honest move. I'm trying to time the second move, which is what I think the honest move for majority of the day, which is 30 minutes out. So if we spike up in the first 30 minutes, once the clock strikes 31, I'm probably going to be looking for the fade, because what happens is the market piles into one direction, especially if it's up. In this case, my opinion is that when you have the market, and it's, it's not just my opinion, you can see this empirically. When the market is positioned into an event, this is not the perfect example, but if the market was positioned up into an event, and has been grinding up into an event, and then you get the spike, well, you had the market long into the event, then you pulled in a bunch of longs after, and you've created a pretty imbalanced structure. So a lot of times that second trade is about positioning, just unwinding. So I don't have any predictions. What I will say is the data upon the release is not really important. I mean, a 2% chance maybe that we get a 50 basis point increase. More likely, it's what the market is pricing in already and what consensus is, and that's 25 basis points. So that's not going to really do anything. You'll have that short-term noise and back and forth after, but the more important details lie in the presser. So that 2:30 presser, so 30 minutes after FOMC, Powell will come on. ECI data today I think, is in favor of him being a little bit more dovish. But like I said, you have a set of ears. You're going to see algos responding. They're going to tell you what they think. The market's going to tell you what it thinks really quickly about what he's saying. If he is hawkish, that's obviously trouble, right? If he is consistent with what he says or what he has said, and he tries to play pretty soft still, right? Doesn't want to strike a hawkish tone, but doesn't want to be, overtly dovish, then I think we're just going to expect the market to continue to move up. So if it is more of the same, I think the market will have that short-term period of back and forth, but then continue on upward over the coming weeks. If it's overtly hawkish, then I think that spells trouble, because I think the markets have been long into this. But other than that, no major change, and I don't think that the market's going to really change. So first things first, we'll just take a look at, this is BTC, but real quick, where the S&P is. You could think of dovish as bullish, right? So dovish would be where, here's a semi-dovish response. okay, we're continuing, they hike 25 basis points, but future hikes are data dependent, right? So leaves it open to no hike in what is it, February or March, excuse me. Leaves a possibility of coming off, right? Or leaves the possibility of coming off on the table, right? Doesn't make any explicit statement about the next hike. Kind of alludes to the fact that there might not be one. That would be dovish, right? The market would be really excited about that. I don't know if you're going to get that, but it doesn't make sense for me to try to predict these things. People jerk off all day on Twitter trying to predict what Powell's going to say. You can just wait till he actually, fucking says it tomorrow. And Powell wasn't an economist. Powell is, he comes from private equity, smart guy, very aware of how the market behaves and the inner workings of the market. So as far as the S&P goes, where the fuck are, language. The 200-day, this was, or rather is, one of the most important moving averages. Why is that? And that's because a lot of trend followers, systematic trend followers, take a look at this. Not that they take a look at it, but their systems are green lit after this. So we have CTAs long already. So people that buy into uptrends, sell into downtrends, enforce the trend, big movers of money. And now you have something that is another signal for sort of slower moving deployers of capital that are also less price sensitive. So they don't give a shit if the signal, if prices, if the signal goes green and then we're up 200 points, they're just buying at that point, right? They're not price sensitive. So we're above the 200-day. We're outside of this running diagonal. The area that I said though was, I think it's right around here. It was at 4,075. So 40.75, 40 on 100. The idea of breaking outside of what was a multi-month range. So if we look at the monthly real quick, no real significant action outside of 41.56 and 47.64 in a closing basis. So if we do that, if we're able to get outside of that, if we got outside of that today, that'd be great. And that's because the monthly has 4 hours left, but I doubt that we'd get some kind of move before the end of the session that looked like that. Not writing it off, it's possible, but again, leading into an event tomorrow, some de-risking. But this, to me, this is giving a lot of signals that at least in the short term, the downtrend is off the table. I personally think the bottom's in. I think the bottom is in for legacy. I think the bottom is in for crypto. The important thing is to not interpret that as me saying the bottom is in and this is the most recent bottom of the last session is the bottom. No, the bottom is all the way down here. So the idea is with BTC and with the S&P, whatever indices you want to look at, the idea is that we could come down and revisit those levels multiple times. And I think it's more than likely that we end up doing that at some point. We left this weird anomaly down here that's makes you very uncomfortable if you're long, at least if you're close by, right? And at least now you have a significant buffer. But that yearly open, that weekly open, it's a monthly open, right? We have a structure that has, it has no wick, right? So there's no probe below the yearly open, which is just in it of itself, it's an anomaly. But it doesn't mean we can't come back to it in a couple months. And just because we came back to it doesn't mean you should be, start extending your targets down to 10K and 12K. So we are in a long downtrend at this point. Damn, it's been a really long time since this initial move, but the market's getting some, it's getting some action in the opposite direction because we've taken out a ton of leverage. We've taken out a bunch of sellers. It's a little bit easier to move back in the opposite direction. And again, legacy risk is moving up as well. So the ES looks good. I don't see any reason to be bearish on this. You have a lot of people talking about the economy and they're making economic projections for the next 6 months, the next year. Even the smartest asset managers in the world, when they get on the, when they get on the desk at Davos, for example, or when they're on, CNBC, the one thing that you'll see asset managers not really want to make predictions on is the economy. Some people do, right? Some of them do, but most of them will say trying to predict where the economy is going to be in 6 to 12 months is a fool's errand. So for anyone who's like, the economy is going to be so much worse and the markets have to go down. Well, first of all, markets lead the economy. Markets are forward-looking. Markets are pricing in the future. And in that sense, because markets have some degree of built-in optimism, or people do, markets will. And it's okay to say that maybe the economy might get worse, but the markets won't necessarily need to make new lows. And that's the high time frame stuff. As far as BTC, and this still does fall under the category of high time frame because now it's been over a month. Really strong trend off the lows. The things that I'm looking at, well, one, as far as this structure on the weekly. So let me, I'll leave this chart on, no, actually I'll take these off. Those are VWAPs. As far as the weekly chart goes, we're right at resistance, okay? I have bought resistance before pretty aggressively. I did it with DYDX. I posted that, DYDX. I posted that a couple days ago. But I would rather deploy higher for BTC. In this case, would mean closing my hedge, then buy into resistance, right? Especially in something that's, larger, takes more capital. It's never really a good idea to buy into resistance for the S&P. Since BTC is moving pretty closely with the S&P, I just think that by proxy, I don't want to be buying too much into resistance or make a habit of buying into resistance with BTC. It's not to say that I haven't bought into resistance before. There is something to be said for picking up on nuance and when buying into resistance and selling support might be a better idea than the inverse. And there's definitely cases where it is. So for anyone who says like you should just always apply the opposite, so always sell resistance and buy support, there's many times when being able to pick up on those slight changes in details or that slight change in order flow can make a world of difference, because a lot of times the move that happens through resistance or through support, that pullback is only in textbooks and it doesn't come back for a long time. And by the time it does, like that's the reversal back into the structure anyway. So BTC for me, the upside, it's not that attractive. So I ended up hedging the other day at a pretty attractive area. I hedged into this structure. So we're going back above the value area of this entire composite at this point. So I'm still in the money and I don't see any reason to close this out for any move that happens before FOMC. Now, mind you, if we're floating higher post FOMC, then I'll change my mind, honestly. Because what we're looking at is an event, and also we're, again, just tapping right at resistance. So for me, if we're past the event, right, and markets are looking strong still, and then we're getting this grind into this resistance, then I'll probably just add to that at that point. But for now, I'm hedged. The risk reward for me looks something like this. So if I was to close out my position and take a long right here, right, from just fresh positioning, this is kind of what it looks like. The next area where you could really define your risk is right here, these lows. And then I think 25 is probably, from a psychological standpoint and the top of the range high, the next major level. This is if you're defining your risk based on these lows of this range. That's not reasonable in my opinion, because if we break through this structure, I think it looks more like something like this, where we're closing out this gap. And I should have just placed this there first, because otherwise it looks like a pretty decent trade, right? If you have a tightly defined stop, you're looking at your risk reward is 2.2 to 1. But I don't think that that's the case. I think that with this kind of structure, and I'll go to the 4-hour now, with this kind of structure, we have these pretty big imbalances that are below us. And what that is like we haven't really built that substantial of structure below, right? So we have long consolidations, we have a big impulse followed by a consolidation, a smaller impulse followed by a longer consolidation. So the market's taking more of a breather up here. And these gaps, so these low volume nodes, if we start rotating towards it after we've had this kind of swing failure up here, so after we've taken out the high, if we start rotating towards it, there's a bunch of lows that we haven't really tested yet, right? So all of these are pretty uninterrupted. So let's just double check if they are. I'm pretty sure this one might have been, that one was tapped and on Binance. But as far as the other lows go, there is a potential for some kind of larger than life stop run, right? Because you have from the beginning of this structure for the most part, on an uninterrupted lows. So no major test of this gap. And that is probably one of the best areas to get involved if you see, all right, so we break into that gap and price quickly reclaims those lows. So if this was single prints, you know, we're looking at a TPO structure, air pocket, the move into there, not accepting, bullish, right? A lot of times you're looking back at the midpoint of the range, and, you know, in this kind of structure, you might be looking at the high. If I was going to guess, acceptance back into this structure, right? So no very, you know, no swift response down at these lows. So a stop run moves very quickly. So covers this entire gap. And then it kind of stands out to me that we're quite extended from, hold on one sec. We're quite extended from this yearly VWAP, which is ultimately the, it's the VWAP of the beginning of this move. So it's kind of like an anchored VWAP. Excuse me. I knew I was going to cough. It's kind of like an anchored VWAP for this entire trend. So on average, that's where most of the risk is averaged around, is averaged about. So I think there's a lot of confluence around this 20,007 daily close, 20,591, and then taking us down into the last major imbalance before the beginning of these consolidations. So if this was a TPO trend type of profile, and we accept back through this gap, I'm looking at ultimately getting involved at the best risk reward area, which is at the beginning of this gap and the beginning of this high volume node, or sort of that ledge, where it really drops off. So personally, I think that we're probably, if we do get a larger pullback, that you do get something that is quite scary back down to this VWAP. So back down to the VWAP, that daily close. So that line I have on the chart is, it actually should be right here. One sec. Let's get a more honest level for that. So instead, it's 20,680. So it's actually really closely lined up to that anchor VWAP. And the first test of that VWAP is probably going to offer the highest probability response. So if we come back down, close this gap, right, I think you more than likely, right, unless we get a response around 21.4, 21.5, I think we more than likely come down to test this VWAP. So accept back into this prior consolidation, test that VWAP, scare everybody, get some kind of flush towards 20, and then maybe that's possibly where we have those moves that catch everybody offside because the market looks like it's going to roll over, pukes into that area, consolidates, and then rips up. My belief is that the trend isn't done. I'm just wondering if we get some kind of move that is a bit more closely resembling of what we got in April 2019. So if you look at this move, so it's very bullish, right? Prior range, right through it, testing the top side of it, beginning to lose momentum though. And if we go back to April 2019, that's not going to be on this chart because this is Binance. One sec. So April 2019, right here. All right. We had an SFP at the high, much larger puke. This was around 11%. Excuse me, from high to low. That is around 15%. But it did the same thing that I'm talking about us doing right now. So that I would be looking for. It pukes back to the largest imbalance, right? It pukes back to the origin of what got this move going. So the make or break level, right? So if price had reaccepted back under, 48, there would be really nothing standing in the way of it moving back quite rapidly back to the origin of that move. Again, the idea being unchallenged positioning. So all of this positioning being unchallenged, not really having a reasonable area to define risk other than, I got in the breakout and, it began here. So if we're looking at where we are right now, same kind of idea. So the idea being, this is a little bit different because this is multiple days at this point. But the idea being that if we're back below 20K, as long as we're above 20K, I'm bullish. If we're back below 20K, then I would anticipate that we're going to come back down, test the high of this smaller structure down here, and then maybe we'll test that yearly open. But that is the area that I think you look to see that panic behavior, back down towards that daily area, back down towards that VWAP. Short term, one sec. Put this back on. We'll get looking at some alts because I haven't been trading BTC really that much. Momentum is better played in alts. So this VWAP, just to answer a question real quick. This is right now anchored to the beginning of the year. So this is DJT.VWAP band. I have it on a quarterly setting, but that still identifies the beginning of the year. So beginning of this year is where it starts. You can see the trend's been really strong. We've been hugging that 1 to 2 standard deviation band. But I think that mean reversion takes us back to this point. So on average, most of the risk tagged on around 20,780. I think that you could spend time chopping around there. But again, that 20K, between 20K and there, you don't want to lose that. Because it's not, the thing about where we are that I think makes it a little bit unique is that higher up with more leverage in the system, these levels become much more significant because people are paper handing and there's more leverage in the system total. But actually where we are, there's not a whole lot of leverage. We wiped out a lot of participants. And this is just, this one right here is just Binance, BUSD and USDT. So it's not the same. Like positioning is not, high time frame positioning is not as sensitive, right? We've seen a significant amount of spot demand. A lot of the people getting involved are less price sensitive, have longer term outlooks on price, at least at these levels. And again, that, with less leverage in the system, you're less likely to see one, cascades be as violent and as nasty or as extensive. And two, for people to paper hand the positions the same way, right? When you're in a market that has a lot of leverage being used, you have really tight pain points. Again, things are very path dependent. Market has to move basically in one direction for most people using high leverage. Well, rather for most people because they're using high leverage. But in this sense, I want that 20K level to hold. I think the best area to get involved is down there. One thing I have to say is I'm mentioning all of this because I think that's the area that I want to be the person to not panic at if we do get down there, because I think that is the best area to get involved. It doesn't mean that I think that we're, I'm not saying I think 90% chances we're coming down to this level. If after FOMC tomorrow, we see that the market is still remaining bid and it's hugging that 25 zone, then I think that you will see that it will just follow what a lot of alts have done, which is they're hugging resistance and then they smoke resistance. All right. Intraday, as far as where we are right now, we're just back within the multi-day composite that we briefly popped outside of to put in that swing failure above the initial high. So this is a 7-day long composite. We rotated back down towards the value area low of that structure. Very balanced price action over the last week and a half. Choppy, right? But we haven't broken to the downside significantly yet. So I'm not writing off the fact that the first major test into this low volume node won't be the one to bid. But I would rather observe that, right? So where we are right now within the structure, I don't see any reason to do anything with my BTC, or rather my hedge. So for the most part, Bitcoin's not really that interesting to me right now. But you could see on this chart, when I was talking about it on TradingView, unchallenged positioning, tongue tie, and weak structures looks like that, right? So one-sided positioning, 2 single print regions separated by a very brief period of value developing. But a lot of times when you see the market move back into this area, these kind of fold and we move through them pretty quickly. So I think the most compelling place to be right now or thing to focus on is alts, honestly. You're starting to see narratives, rebirthed. But I think for the most part, it's bullshit, right? We're just playing the game where we're chasing momentum. I have a few things that I'm focused on. DYDX is probably, so I don't know if it's DIDEX or DYDX. That's probably the thing I'm most bullish on in the short term. So we'll take a look at that chart. Let me look at the chat real quick. So one thing to point out, in this rotation up for BTC, we've had a good amount of absorption. So we have the market moving up, but actually spot CVDs, Binance, and Coinbase trading against that. And if you look at the funding, it's actually coming down after peaking down here. So market spikes down, funding spikes, and now we're slightly coming down and open interest is going up. So I think it's honestly possible that the market is doing a really good job of absorbing people like me, right? People that are hedging before the event, which is just a practice that I've always done, right? Something that I've always practiced, rather. I don't want to be long into an event. You never know. You know, there's a 2% chance that Powell could come out and say 50 basis points. And if he does, like, that's a really shitty lottery to win if you're long. But it is entirely possible that this buildup right now in open interest is due to those shorts being absorbed. And one thing that stands out is you can see funding coming off. You can see spot getting absorbed. But if we look at something like spot on, one sec, go to Binance. So here's the spot market trading at, this is trading at 145, and we have the perps trading at 137. So there's like a 10-point difference. That's not massive, right? I mean, you have to take into consideration, though, that prices are lower. Like a 10-point difference at 50K is different than a 10-point difference at 23K. But spot trading consistently above, for the last couple of days, consistently above the perps. If you look at like BUSD and the BUSD perps, same thing. So the perps are trading at a discount, spot is trading at a premium. The entirety of the structure, it hasn't necessarily been that case. So if you look at BTC, just the high, go to perp, just look over the course of the structure from here to here. You know, we've been trading. It's been mostly on positive funding. So mostly on positive funding. We saw two pretty big wipeouts. But I think the closer and closer we get to an event like this, I think it's more reasonable to assume that people are selling into the event, not buying before the event. So good job on price remaining bid. All right, look at the chat, and then we'll take a look at the DYDX chart. These volume bars on the right, this is volume profile visible range. So depending on what is in the field of view, it's going to show you the volume profile for that structure. So basically, you'll be able to see where most of the volume came into the market, where the low volume regions were, where price is beginning to build on volume, where value is being established, or in this case, volume. But if you're looking at TPO, value. So about playing these conditions. So, there are not a lot of people that are able to switch between trading their intraday system when the markets are bracketed, when they're more range bound, when they're choppy, to a system that is based on momentum. And crypto is, an amazing asset class to trade if you could trade momentum. So if you're able to switch between those two different approaches, right? So me, for example, I could focus on intraday and trading using just TPO and order flow for 9 months, right? And then you could have a period where the market is breaking out, and I'll start focusing more on moving averages and just trading breakouts. And in these conditions, you're not going to get, so for example, if we look at, the FXS chart, I think is a good corollary for the DYDX chart. So we'll take this off. So for those of you that ask like what indicators I have up, I barely have any indicators on my chart. I'll mark off levels where good volume came in or significant volume came in. But a lot of the indicators I have in my chart, and I'm just going over this because some people have asked before, they're like silly things. So daily open. This is periodic volume profile, seasonality. So I could highlight months. I could highlight days of week. Just if I want to see how Mondays have behaved, price action wise for the last month or so, previous day high or low. So nothing fancy, no like MACD or anything like that. Mostly based on highs, lows, closes, stuff like that. So anyway, trading the breakout. So here is the FXS chart. Here is the DYDX chart, all right? In a TA textbook, your best trade for this setup is confirm that this is a breakout, gets a daily close, comes back the next day, offers you that perfect entry at the top side of the structure, and then you get a clean move up. Now, what I will say about that is, yeah, that more than it might eventually happen. And a lot of the cases with alts, you are seeing that is happening, where the market is consolidating here briefly, puts in one strong red day, and then puts in a green day back towards the high. And this 99% of the time you could buy. This is, I should say, this is a lot. All of these setups I've been buying. So cases where we've had a spike up, because you can't, buying this kind of breakout, for one, this is from the open today. This is 16%, 17% off the open. I am of the opinion that this continues much further. I am willing to place a stop below this open and start building a position. If I arrive to, like, for example, a fresh chart, right? If I'm stumbling on this for the first time, I'm going to start looking to build a position. I'm not going to wait necessarily for it to come back to this level. I'm going to start building a position, and my main invalidation will actually be back below this close. I'm of the opinion that, this is going to be continuing for some time. It might offer a pullback. It might not. But I'm making sure I tag on at least half of what I want. And I might get filled on that remaining. I might have to chase it up. But either way, it shouldn't be back below this close. If this is the breakout, it shouldn't be, excuse me, it shouldn't be back below that open. For the cases where you're arriving to the chart and you see something that has consolidated for a few days, has retested this with one strong red candle, and then is moving back towards that consolidation, 9 times out of 10, you could usually buy this breakout. And that is like one of the highest EV trades. So for example, it would look something like, this is your range. Buying this pullback is not as high or as positive EV as buying this breakout. So just to clarify, this is kind of the concept that, some other traders have talked about, called the buying the right side of the V, which is, instead of also buying on the way down, buying on the right side of the V. Right, so buying when you have confirmation that, for example, if this is a downtrend, right, and this is the ultimate low, buying on this side is higher EV than buying down here, even though this was a better entry closer to the low. Just there's a higher probability that it's going to resolve favorably when you see the market is showing signs of strength. So for a breakout, yes, this kind of pullback setup, that looks good, right? You'll be able to get a good entry. But honestly, I'm more apt to buy something like this. So the pullback and then the break of this high. Just the idea that this level has done its job at this point, and that more importantly, this long consolidation is not just going to result in a really small move that's kind of one and done. If it does result in a small move, it's probably not going to offer this bounce, and you're probably looking at acceptance back into that structure. But in most of these setups, to be honest, and this is a bad example right now because I've already been in DYDX, DYDX spot, right? So most of my futures positioning is hedged and flat right now. But in alts that have been breaking out like this, I've been basically just buying and placing invalidations at the low and then looking to rebuild more into the position as the day progressed. So let's see. Give some examples. So this is on deck. As you can see, I'm kind of trying to, okay, so here's an example. So this is anchor. So this is a key weekly level, lows, first pivot on the break of that, continuation. Now we have sort of this under over structure taking place. So we're currently reaccepting back into what was a multi-month range. All right. Now this is a pullback that is offering you the, some of the most attractive risk reward, right? Rather than buying up here into the structure. So you're getting the pullback to these lows. I personally think that it's better to buy in terms of certainty, unless you're really bullish on Anchor. But this is how I'm looking at my trades. I am more inclined to buy the move back up to this high and place a tight stop underneath the structure on the way up, then buy the pullback to the structure. Because this could very well be pullback that just fails, whereas the pullback to the structure followed by a move back to the high, it's telling you that this location did its job, and it's very unlikely that after this trend is reversed, that if this didn't sell off and lead to continuation down from here, that it's going to do its job as we return to it. So more than likely instead that we continue on up from there if we're retesting that high. So that's the idea of, again, if we're in a range and we break out, I don't really care about buying that retest. I'd rather buy this, right? And then place my stop somewhere in this structure. And, the loosest stop would be below that low. So buying below that impulse. But, if you're waiting for pullbacks, in a lot of these breakout setups, you're not getting them for, sometimes days or weeks. And by then, you might be shaken out of your opinions because the rest of the market might look like it's rather in completely different conditions. So that's the concept of buying on the right side of the V. So this is FTM. So it looks great, right? Chart wise, lows broke down, reaccepted back within this range. Now we're on the top side of that structure. A lot of times if you want like in a maximum target for these kind of setups. So let's say you have a consolidation that puts in a deviation at the low and reaccepts back within the range. Talk about this all the time. A lot of times they're just targeting 1 and then 2, but more often than not, if we're looking at a low, a possible macro low, right? Multi-month buildup. More often than not, you can expect this deviation at a minimum on the other side. So I should say that instead of cutting position short at, T1 and then max T2, it's often the case that this deviation offers a measured move at the high at a minimum. So if you got, a 4% deviation below this low, well, a lot of times you could expect a follow through of at least 4% above these highs. And that's, just a stupid example of using percent. But the idea is a measured move at the top side of the structure the same way we had at the low, right? If this was a deviation at the low, reaccepting back within the range, ultimate target of range high, but more often than not going to overthrow more than that because we're going to run those stops. So if you're just trying to look like, if you're trying to get the most out of your positions, as long as we're on FTM, and when I said moving averages, I've always talked about the 20 period moving average. Most of these structures have been holding the 20 and the 10 on the daily. So the daily trends are still very much intact. So when we start trending, you don't want to cut your position short just based on, intraday noise. You want to be able to see that you are actually trading positions around those newly established norms. So if you're trading a trend, take into consideration the trend. If you're going to place some kind of stops, take into consideration some level of volatility. You have to be able to shift from one approach to the next if we go through different, if we are in a different environment. You don't have to, right? You could still trade level to level intraday, but you can make a lot of money if you're able to make that switch, right? Because the market has been putting in more than 10% moves. So as far as FTM, this is how many months? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9-month long bottom. Not a TA dude, but kind of looks like one of those Adam and Eve structures, right? So Adam and Eve, or progressive, Adam and Steve, Amanda and Erica, whatever you want to have. Top side of that structure into an area that is unchallenged, right? So this is a very imbalanced move down. If this holds the top side of this structure, which it looks like it's doing so far, I think that it's more than likely that we get at least a move back up to this this consolidation up here. So I shared a chart of this a while back. So you're looking at this really low volume node being tested. So right around 65. So what that looks like is, clearly the market is choosing a new direction, right? It's unlikely that this is a deviation. Absent any kind of 50 basis point hike, crypto is still going to go up, in my opinion. And for everybody who, is in awe about how this market can go up, look at all the money that came out, and then remember that it's a much smaller market to begin with. It takes it takes very little to move this market. So as far as a breakout side of the structure, I would even say it's reasonable to define a position like this. Why is that all the way down there? One sec. It's a wide stop. It is a wide stop, but oh, excuse me. No, that's not. I'm looking at this gap and forgetting the first target 65. It's reasonable to assume this reaches 65, but in terms of a really wide stop, no, not so much. Below this low, 2-to-1 trade still. Does that low hold? I think that it's possible it holds if the market continues to hold its footing overall. But either way, if you could see that an opportunity exists, but not have the best way to define a position around it. I still think either way that the breakout side of the structure is going to lead to much higher prices for FTM. You're starting to see Andre come out, be a little bit more vocal. These protocols and teams, they want higher prices to distribute some of those bags. As bad as it sounds, and if you're buying into the cartel crap, which I think is nonsense, even though this market is ripe with manipulation, I think it's very unlikely that we have a prolonged downtrend like we have, prolonged sideways period, and then this is the extent of the trend outside of that structure. This is a major directional change. Now, that doesn't mean that this takes out the all-time high, but it more often than not, if we're being honest, means that this is going to have a significant amount of legs to it. To put this in perspective, like if we look at ETH, for example, and we look at the high time frame chart of ETH, and we put on something like the 200-day, and we look at the times that it's broken above, all right, and if we even just isolate for bear market periods, you're still left with, so more importantly, right here, that doesn't necessarily count up there. There's not a whole lot of sample size, but this is a major shift in the trend taking place. Is this the extent of it? Unlikely. I think at a minimum, if we even just use this as proxy. So if we're 1, 2, 3, 4 weeks in, this is, we're looking at closes above. So 1, 2, 3. I mean, that'd be the smallest example. But if we look at this, this is kind of closer to what we have back here. I just think that it's unlikely that we've seen the extent of this move. The mean reversion, after a period like this, it's not going to, let's say, one sec, let's put on something like a fib. I mean, I don't want to be this generous. That's why I'm a little cautious about saying, let's say from the high to where the low is, and we get a 50% retracement, which is not uncommon, 29. And then if we did that for BTC, from the high to the low, 42. I don't think that, that's not where I would target, but I think it's reasonable to say this isn't done until 30K. I mean, from a price action standpoint, yeah, there's two things you have to identify. One, the bullish thing is that there's two things that you have to be willing to entertain at the same time. From a price action standpoint, this is bad. So that yearly open down there is ugly. Same thing gets applied to daily structures, 4-hour structures. More than likely, things like this get cleaned up, meaning they get revisited, swiped, and then we resume whatever course we were taking. But that can happen over here, right? Doesn't mean it has to happen in the next day. It doesn't mean it has to happen in the next week. If it's on a daily structure, a 4-hour structure, A lot of times I could use it as a target if there's a trade that beginning to shape up around it, like prices beginning to show weakness. And if we're back below 20K, like I said, then I'd be targeting that. But from the bull standpoint, from a price action standpoint, we're holding prior structure highs, like as bullish as it gets. I talk about this in low time frames all the time, and it's not, hard to understand. A structure like this that breaks down, one, it has an easier time moving back through the structure if it reaccepts. But two, if it moves through this and rips through it and then finds the top side of this as support versus like struggling in here and then kind of, dilly-dallying around the lows of this structure. A move back above, treating the top side of the structure as support shows you that a major change is taking place, right? All of the sellers right now, if they're still open, underwater, the buyers are maintaining a bid previously where sellers have been overwhelming them. Like it's very obvious how you could see, this behavioral, what kind of behavioral switch you could attribute to this. So that's kind of what we have right now, with the exception that, if you looked at this on the weekly or the monthly, we're still at those levels. So it happens to be that, like when you zoom out, I guess the more recent period of this consolidation, because it was like, the market really died in terms of volatility. You had a lot of dispersion, followed by a market that was getting much tighter. So my point is, you're holding the top side of this structure, had no trouble all the way through, like zipped through, good amount of shorts being squeezed. It's not surprising that you zip through because, again, imbalanced structure, accepting back above, I'd said this multiple times, accepting back above these lows, that POC, and this pivot, like there's not much standing in the way, but now holding the top side of the structure. So I don't think it's done. Does anyone have any questions? So I think file looks good too. So here's file, weekly lows for, multiple months, quarters at this point, breakdown, retest, and now retesting it from above. Something to keep in mind. This is the sign of the trend shifting on the high time frame. Doesn't mean new all-time highs, right? But it's going to be slower moving. It's going to be, by definition, higher time frame, right? So, if this is a 5-minute move, you're not going to expect it to change the weekly structure. But if it's a weekly move, you're not going to expect it to be something you should manage on the 5-minute structure, right? High time frame evidence trumps low time evidence. My point is, like, you don't want to micromanage these positions or changes. If you're getting into Filecoin, for example, and you're getting into it on behalf of this level holding as support, don't stay on the 1-minute chart and monitor this, because you're going to get chopped up, because there's going to be a lot of movement, because there's a lot of data points in a weekly candle, right? But the fact that it's changing on the weekly, the fact that we've retaken weekly and monthly levels, right, and these high time frame changes have taken place, does mean that because it is a larger data set, that there is more significant change that has occurred than if you're looking at, again, a 4-hour chart, a 1-hour chart, and even lower. So with Filecoin, I think that this is so far, it looks like it's a good retest. Again, me personally, I've liked to not necessarily get myself in a position holding things, but instead see something like this. So see this consolidation, and then when we get that move through this high, then a lot of times I'm going to be playing that breakout, because you're seeing that moves that occur from breakouts are like 10, 20%, and you could compound those all day. Ryan, I find using Coinalyze data good for trading. Are you using it too? Yeah, I'm using it. I'm probably one of the earliest people to use Coinalyze. Actually, fun fact, now that everybody uses the platform, the dude who made Coinalyze, very talented, He was the guy who made my custom indicators like 3 years ago, before Coinalyze was even a thing. Unique flow. So unique flow, like changes in microstructure, TWAP behavior. There was definitely TWAP behavior taking place on DYDX earlier. So a lot of times that when the TWAP is taking place, you could see it in this like very, the interval of price movement, or the pattern of price movement, has a very specific looking interval. So it might look like, buying every 30 minutes, buying for 30 minutes on, letting the market cool off, buying again for 30 minutes on. If you look at this DYDX chart, it screams TWAP to me, right? Maintaining a bid. You have these like this is if we're looking at a 5-minute chart, kind of looks like every 10 minutes there is a market buy. So someone is filling a position here because there is a significant change in market structure, and they know that this is probably going to go much higher. As far as like specific TWAP behavior, one thing to focus on, and this was popular during the last cycle, when let's say that FOMC, no major changes tomorrow, markets continue to move up, S&P moves up through that key level. And the trend is now on, and we're looking at a Goldilocks period of like 2 to 3, maybe 2 months. When you see a New York Open on Mondays, there was a pretty obvious TWAP taking place in BTC, so on Coinbase. So look for that behavior, and it's kind of like it's a free trade at that point. But TWAPs have become a lot more popular lately by retail, so that's one thing you have to consider. If you see that TWAP footprint on like a $50 million market cap coin, I mean, it's not that significant. If you see a TWAP that's taking place on BTC or on some larger cap, and it is, of size, then yeah, you probably want to get behind or along that flow. Yeah, I mean, you asked me about Coinalyze, and this is Coinalyze. So open interest, liquidations, predicted funding, weighted by open interest, and then Binance Spot and Coinbase Spot CVDs. You'll see me change things from time to time too. If I see something might be a little redundant, or getting the same data, then I'll eliminate and just keep one version. So for example, predicted funding, a lot of times you're going to see corresponds with something like the, future CVD. Yeah, someone is just buying this all up. It's probably Andrew Kang. Yep. Good trade. But more of a point that, if you're waiting for the pullback, this is like the micro pullback that you got. I mean, if we extend this all the way back, is it anywhere that's relevant? Yeah, it's the highs of the structure for the most part. So you have to be willing to get aggressive in this environment. And I had mentioned, what did I say on here? I'll post it right on because I got some shit for saying this. This is what I posted, and this was on the 27th. Look at the similarity between these two charts. The same way I added to Frax, I'm going to add to DYDX at resistance. The idea was, like, one, there is a uncanny similarity or resemblance between FXS and DYDX. All it is like the market is unable to move lower and has been in a really tight range. This is the third tap of resistance after the third tap of support, and on this move specifically. So, how do you identify that this was a good resistance to buy versus all these? Well, all of these did not occur in the same context, right? It is clear that right now, for this entire leg, the market breadth, so the health of the entire market, everything is moving up, and that there's a lot of momentum. It's not like this is popping off and the money is coming out of that and then going into this, and it's a small rotation that lasts a couple days. This entire structure has been on a very strong market that's seen a lot of capital redeployed, and equities have looked good too. So completely different context. And now you take that into consideration. You say, well, this is the third tap of resistance. We had that third tap of support. I'm confident about the next couple of months. This lines up with my thesis that I said back in June of last year. So this is probably a resistance to buy. And worst case scenario, I'm wrong about something and, you know, I lose a little bit of money. But if I'm right about this, I mean, I have the potential to make a lot of money. And we're looking back at, you know, now price is up 39% from my entry. So, you know, I hedged on and off between then. I personally, again, I don't like to carry risk through FOMC, but I'm not completely hedged. My entire portfolio isn't delta neutral, but I've definitely given up upside by remaining hedged. But I think it'll be negligible. I just trade around this stuff and I make up for it, you know, for the amount of money that for example, when I'm hedged, a lot of the times I can make that back up by trading around positions. Please, dark mode. I'll do a dark mode until I'm not until next stream. Am I flat? I am hedged on most of my portfolio, yeah. So see this? This is one of my trading accounts. So 100% tether. I've just been trading the last 2 days leading up to FOMC. So flat means all in stables or completely out of positions or hedged. So, but yeah, I think that'll cover everything. I think that there are going to be a lot of opportunities shaping up. I think that a lot of, you know, we've seen a ton of great activity leading up to this. But I am waiting for FOMC because a lot of the pairs are at resistance. There's only some that I'm willing to buy into resistance, like DYDX. But I think that if tomorrow goes smoothly, the watch list that I have is going to become a much more active watch list. Something to point out, Solana. There's a lot of similarity between this chart and ETH early chart. If the rest of the market moves up, though, this is just going to smoke resistance. So it's heavier. It's more capital required to move Solana, but I haven't lost confidence in it. But that's it, guys. I'm going to wrap it up. LTC, INJ, I don't even have it on my watch list. So that probably tells you something about it, or at least my opinion of it. I mean, in terms of high time frame levels, LTC is right at one of the main ones. Just go to these lows and that weekly pivot. So if we had bad news tomorrow, then maybe we have some great backside setups to take advantage of on the short side. But I think it's more than likely everything continues to move up. I made a post the other day about Dino coins pumping, you know, kind of canary in the coal mine for a pullback. And then we got a pullback. We got like in BTC, we had a 7% or 6% pullback. So listen, they're aggressively buying this up. But that's it. I'm going to wrap it up, guys. Thanks for tuning in. If you're looking to trade on an exchange with an option for no KYC, you can KYC if you want. You get some added perks. But the link is Trade Phemex, and that is where all of these alts are being traded. So until next stream, I went over the